Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 22nd of January, of course. A notable week just gone as earnings season continues to rumble on. We saw outperformance once again from the likes of Goldman Sachs, with the investment banks doing particularly well, and we're going to be shifting our focus going forward. But in terms of the economic sort of side of things, there's been a big focus on the UK in particular, with the inflation gauge coming in hotter than expected, tempering expectations for that May rate cut from the Bank of England. That did reverse somewhat on Friday when we saw, of course, a weak retail sales number coming out of the UK, both volume and value heading lower. And that's not something we're used to seeing. So could this temper expectations for inflation and for consumption in the key end of last year, and certainly around about that Christmas period? That's going to be something worth watching out for as we move forward. But this week coming has plenty to sink our teeth into. And so I wanted to take you through some of the sort of wider picture events to look out for, and then take three segments I think we should be looking for to trade around. First and foremost, this is the outlook for some of the top tier releases over the course of the week, starting off really with that Bank of Japan interest rate decision coming out at 3 a.m. on Tuesday, so essentially Monday night here in the UK. On Wednesday, we've got a big focus on the PMIs, and we're going to be coming into that in particular in Europe. And we've got that Bank of Canada interest rate decision coming out in the afternoon. That central bank theme continues into Thursday as we see the ECB coming out with their latest monetary policy decision, and the outlook for potential easing from the ECB will certainly provide the basis for trade when we're looking at Eurozone markets, but also the Euro as a whole. And then we really kick off the big data deluge coming out of the US. We've got the likes of core durable goods, the GDP reading. We've also got on Friday the likes of the core PCE price index, inflation gauge, personal income, personal spending. So a lot coming out the back end of the week from the US. But certainly as we kick off the week, the focus really is on Japan. And that Japanese interest rate decision is going to be really notable. Certainly, it wasn't that long ago that we saw some hints from the Bank of Japan that they were thinking about potentially tightening interest rates, moving out of that negative territory. And that's because inflation was moving higher, and that was driving up wage expectations. Now, this is the key part of it. If inflation can remain elevated and above target for long enough that people start to demand higher wages, and that becomes baked into the economy, then this has been a particularly successful period for the Bank of Japan, because it's something that they've struggled to do and struggled to achieve for a long time now. Unfortunately, inflation is starting to head lower, and we've seen that as we close out this last week. We saw the inflation rate for Japan down to 2.6% from 2.8%. And therefore, we're already starting to see inflation head lower, and therefore we're expecting to see a similar kind of thing in terms of wage expectations. So that tempers expectations for the Bank of Japan to lay out a potential tightening policy going forward. So that really does bring the potential for volatility if we do see them sort of moving away from that somewhat dovish or somewhat hawkish stance, and essentially state that if inflation just moves back down to target and if wage expectations decline, then they perhaps might not necessarily tighten after all. So certainly that's going to be key. And also look out for a number of these other metrics. Certainly when we're saying that, inflation needs to almost remain somewhat elevated, we don't necessarily need it to move higher, but we need it to remain elevated. That's going to come into question on Thursday, bearing in mind we've got the Tokyo CPI readings. Now, Tokyo generally leads the nationwide figure. So where Tokyo goes, generally that's a good idea of where we're going to see that more lagging or delayed nationwide reading come out. So expectations here pointing towards a decline across the board in terms of the year-on-year figure, in terms of the core figure, and that doesn't necessarily bode too well for those hoping to see the likes of the Bank of Japan tightening monetary policy. But that does bode well for the outlook in terms of Japanese equities. The Japanese 225 or the Nikkei 225 certainly has been a big outperformer of late. I just wanted to highlight it by showing you exactly how things have played out over the course of roughly the last month in comparison to, say, the S&P 500 and the FTSE 100. They have essentially flatlined when it comes to the S&P 500 this month, and we've seen the FTSE tracking somewhat lower. Nikkei 225 over the last month has moved roughly 10% higher. So certainly this has been a big outperformer of late, and suddenly it's coming onto people's radars. If we were to see a more dovish stance from the Bank of Japan, you're looking at the potential for further upside. So here's how things are shaping out on the hourly time frame. Certainly very notable that we have seen this pullback that's rallied back up towards that prior peak that we had here. So we've got this sort of resistance zone here in terms of, there we go, 36252, 36215. So a breakup through that level, of course, provides us with that sort of bullish signal as we move out of this retracement phase. But certainly the fact that we've rallied into such a deep retracement, if that is a retracement, it's so deep it's moved past all the fib levels. Now we've rallied, we're weakening a little bit here on the Friday, but I think there's a good chance that we do see this market continue to push higher. So a breakback below 35798 signals a wider retracement coming into play, potentially into the 356s. But until that happens, I think there's a good chance that we do ultimately break through resistance. And the expectation that we're going to see a decline in terms of the Tokyo inflation gauge, and that we're going to see a potentially dovish stance coming from the Bank of Japan does signal to me the possibility of further outperformance here from the Nikkei 225. Then shifting our focus to the Eurozone, it's going to be a busy week. Certainly on Wednesday, we're going to see a whole raft of data coming out from the PMI perspective. This essentially is going to tell us the health of the economy. Some of these numbers have been actually improving. They all remain within contraction territory, certainly when you're looking at the likes of France and Germany and the Eurozone as a whole. Haven't necessarily been faring well, and the over-reliance on manufacturing within the region hasn't necessarily boded well, unlike the likes of the UK, which is actually outperforming many of the sort of Eurozone nations, in part due to the fact that services generally has been doing much better than manufacturing over recent years. And of course, the UK economy is heavily geared towards that. Thursday, we see the ECB interest rate decision. We're not necessarily expecting to see any change there, but certainly if you look at the tone coming out of some of these different ECB members of late, it has been one of caution. Don't expect us to be cutting rates anytime soon. Don't expect us to cut rates in the coming meeting or the next few meetings. This idea, in my mind, is that if markets front run the move by, for example, predicting that they're going to see such significant interest rates that we see, say, mortgage rates come down in a meaningful manner and the like, essentially you're seeing that tightening of financial conditions reverse before they actually take any decision. So it's doing the job for them. That essentially means that there's less emphasis on them to ease interest rates. And so there is in part a case to say that, well, the tone that we're seeing from the ECB is one of them trying to temper expectations from the market so that their interest rate cuts are actually required. Otherwise, they're not. And they want to be able to cut interest rates because the economy isn't faring particularly well. So let's look out for the tone from the ECB. Certainly, if you look at them, the Eurozone compared to the likes of the Federal Reserve, I think it's highly likely we're going to see the Eurozone get back down towards that 2% target in terms of inflation before the US. But we're seeing a more hawkish stance from the ECB versus the Federal Reserve. So there's that disparity playing out. And so the tone from the ECB and the outlook for interest rates is going to be really important as we move throughout the week. In terms of the chart that I'm looking out for, here's euro sterling. Bearing in mind, we've seen some movement recently around expectations for the Bank of England in terms of that interest rate cut previously expected in May. Now it's essentially a coin toss. It was at 70%, now roughly 50-50. And so we've seen a rebound for euro sterling, in part because we're seeing this tone also coming up from the ECB about them being a lot more hesitant than markets are currently pricing. But we're seeing this sort of downtrend playing out over the near term. So it does signal the potential for this to be a near-term retracement before we move lower once again. I'm just going to get the Fibonacci retracement drawn on and show you this deep zone, sort of around about your 0.86 zone, really splits the two. But so near-term upside for euro sterling could bring a reversal if we see the ECB finally admit that actually they could be cutting rates soon enough. If they continue along that hawkish line, then there is a possibility of further upside to play out. But certainly, unless we break up through this 862 swing high, the near-term trend that has been playing out over the course of this month thus far does look likely to continue. And then finally, I wanted to touch on the US. Of course, we have on that big PMI day playing out the host of PMIs on Wednesday coming from the Eurozone, coming from the UK, and of course, coming out from the US. Expectations here point towards weakness across the composite reading, the manufacturing reading, and the services PMI reading. That might be a good thing for markets at the moment. They're seeing things as bad news as good news. You know, the weaker the economy is, the more likely is that the central banks are going to feel like they have to take action. That being said, the composite reading is still in expansion territory, so it's not necessarily something that at the moment they're desperate to take action to guard against. But certainly a move back towards that 50 threshold could signal a possibility of a weakening of the economy, and that has implications in terms of monetary policy. We also see the GDP reading for Q4 forecast to drop down to 2.3%. That's an annualized figure. That explains why we've got such a big move, but certainly a significant weakening. And that also plays along the same lines as that downside move for PMI that markets are expecting. And then I wanted to draw your eyes towards the core PCE price index around about the back end of the week. This is going to be a key one because whilst markets are obviously focused heavily on CPI, the core PCE is the metric that the Fed do prefer. And in my mind, I think it's likely that we're going to see the core PCE get back down towards target before the likes of the headline CPI and the core CPI reading. So arguably, this could be the reading that really justifies the idea that the Federal Reserve could move relatively soon. So keep an eye out for that inflation gauge as any significant movements are likely to provide volatility for markets. Let's look at the dollar index. Of course, we have been seeing a bit of a pop at the beginning of this year, in part due to the fact that we, of course, have been seeing this risk-off play as markets realign towards the view that maybe we're not necessarily going to see quite as swift or as many cuts from the from the Federal Reserve as markets have been pricing. Seen a little bit of a pullback into Friday's session, but I think unless we break the 103.14, there's a good chance of us moving higher once again. The daily time frame, though, does highlight this wider downtrend that has been playing out around about the back end of last year. And so the question mark here is, are we retracing once again before we head lower? Well, as you can see here, we've pushed well beyond that 76.4 Fibonacci level. We are seeing some indecision candles here at the moment, but I do think there's a good chance we're going to push higher. And certainly if we do break up through that resistance level that we've recently set at 103.692, that signals greater confidence that we're not retracing, that we're going to break the 104.253, and that we could head higher once again. So, you know, this is something I've been talking about a lot recently, this idea that we could see a sort of risk off move coming into play just because of this misalignment when it comes to market expectations in terms of rate cuts and the expectations being set by the Federal Reserve. It seemed rather lofty to think that we're going to see a rate cut in March and then a rate cut every single meeting for the rest of the year, given the strength of the US economy thus far, and given the fact that I don't necessarily think that we're going to see US inflation head back down towards 2% as quickly as that. Markets are starting to reprice and starting to see a convergence between those two views. That points towards the potential for risk off over the near term. And that does give us the potential for upside in terms of the US dollar and weakness in terms of things that trade against that. That can be the commodity markets. So potential weakness for, say, gold and Bitcoin and things like that over the near term. But if you look at the wider spectrum over the course of the year, things do look relatively positive as we move back towards a period of easing in terms of monetary policy and therefore risk on for risk assets and weakness in terms of US dollar. I just think there's the potential for further bumps in the road for markets. And that's exactly what has been playing out thus far in terms of the beginning of this year.